2021 is here, and if you want to keep that pipeline screaming, loan officers, you better get your non-QM deals in order. You want to talk to a non-QM account rep and learn everything that Oaktree Funding has to offer, which is a lot right now. Click the banner you see right here on your screen, right below the video. Click it, fill out the form, and account rep will get a hold of you. They'll even train your whole team or office on everything that they've got. Oaktree Funding non-QM for 2021. Don't miss out.
Hey guys, long time no see. It's been a while. So 2021 is going to be defined in part by the non-bank lenders IPO. United Wholesale Mortgage IPO is now scheduled for January 22nd. Better.com has an IPO on the horizons. Now, in case you haven't heard of them, because I hadn't, they're a digital lender and the word is their IPO is going to raise $4 billion bucks. Have you heard of them now?
Nope.
Rocket companies, well, we all know them. They went public. Caliber and AmeriHome, they're going public as well. And now Guarantee Rate just purchased Stearns Lending. Stearns, who used to be the largest wholesale lender in the country, they're now owned by Guarantee Rate. Why did they do this? Well, so they can go public as well. What the hell is with all these non-bank mortgage related companies going public? Outside of the obvious, of course, which is we all know, because there is a whole bunch at the top of the food chain with these companies, those folks, those CEOs who see big dollar signs, and I mean big.
Okay, so these lenders are looking at cashing in on our record year. I should say years. We don't have 2020's final volume total yet. It's kind of like the US election. It's gonna take a while to tally up the numbers, but according to the Wall Street Journal, in the first 9 months of the year, lenders extended $2.8 trillion of mortgages, according to industry research firm Inside Mortgage Finance. The boom is extended into the final quarter of 2020, prompting analysts to predict origination volume will exceed the prior record of $3.7 trillion in 2003.
Alright, makes sense, right? Let's sell high. Get while the getting's good. I get this. It's a good time to go public after a banner year. Okay, so here's my question. With so many mortgage companies, these non-bank mortgage companies going public around the same time, will this dilute any one company from meeting or exceeding their IPO? I mean, if I have $4 and 10 $1 candy bars to choose from, which four am I going to pick?
Here's a quote we found for you. US IPOs raised a record $58.1 billion in the third quarter from 152 companies. The IPO window remained open for private companies looking to transition into the record-setting public markets. The average IPO returned 46%, while the average one-day pop was 43% across all IPOs, more than double the same quarter last year, signaling continued investor appetite for IPOs in a capital-rich environment.
Alright, so maybe they won't get diluted. Now, what if next year isn't the banner year that 2020 just was? Could that cool the jets? After all, according to the ever-positive and enigmatic Diana Olick from CNBC, mortgage demand from home buyers pulled back sharply even as rates ended 2020 near record lows.
She hates everything real estate and mortgage. I mean, could she be right? I don't know. Certainly not where we're standing, right? The mortgage and housing market look to be full steam ahead. That's what everyone else is saying. Truth be told, the advisors and the companies that are taking all these mortgage companies public have a pretty good idea of investor appetite. And even if some of these companies don't hit their mark, it's still gonna be rivers and waterfalls of money. Lots and lots of money. So what does this mean?
Well, these companies going public have one goal and one goal only. Actually, it's not even a goal, but it is a legal obligation. It's an obligation not to the loan officers, no, or to your clients. It's to their shareholders. And that goal is simply to make money for their shareholders. Now, there's nothing wrong with this, but that's the legal and moral obligation of those who run publicly traded companies.
So loan officers, just understand this. If the goal is to make money and a handful of companies are going public, you can expect to see more and more acquisitions. Yes, with all the newfound cash and newly minted corporate mission statements, you can expect these cash flush mortgage companies to go out and acquire smaller companies.
You know, like the one that you work for right now. That means in the future, there's a good chance that you're going to work for one of these larger mortgage companies.
Consumer direct. Again, the goal is to make money.
All we need to do is get your confidence back, so you can make me more money.
The most expensive component in a mortgage, it's the loan officer. Now, I know how important you are and how your company couldn't exist without you, but do they know that? Again, if the goal is to make money, which is now the legal charter post-IPO, then I'm duty bound to profits for the shareholders. That means I'm gonna bust my butt to reduce costs, and that could be you, so that I can increase my profits.
Guys, don't mean to be Debbie Downer, but these are all IPOs and they're all coming towards you, and they are legal and duty bound to their shareholders, not you or your clients. Further, you're going to see less control. Okay, one thing about corporations is they don't like rebels and free thinkers. Ever go to a McDonald's?
Where's my Szechuan sauce? I'm Pickle Rick! One below the dum-dum! I'm Pickle Rick!
And order a corn dog and a taco? Absolutely not! Why? It's a corporation and the product is tightly controlled by the company. It's not a bad thing, but it is a thing. And this is what mortgage corporations are going to do.
Now, this isn't gonna happen overnight, but it's certainly going in that direction. This whole thing has been inevitable. There's too many qualifiable pieces to an origination that can be automated today for this to not happen. The question is, for LOs, is if this is true, what do you do about it?
Now, we are in no way Get your fans. Now, we're by no means saying that the role of the loan officer is dead. Absolutely not. But we are going to have to see a massive and drastic transition in terms of what your value proposition is in the entire transaction. We've seen this with the real estate community right now, trying to redefine who they are in the face of all the iBuying platforms. This is not iBuying platform, but it is going to change, and mark my word, these corporations are going to try to find a way to automate the loan officer out of the transaction. All you have to do is look at Quicken Retail. That's a model that every company, every mortgage company is going to try to emulate in some way, shape, or form. Hey, listen, we're going to be talking about this in the future and talking about value propositions that a loan officer can transition into in order to stay relevant, maybe even more so than they were in 2020. With that said, make it a great day. Subscribe if you haven't seen us before, and share this with anybody who you think might be interested, especially in the mortgage space. But if you want to get this every day, all you have to do is this.
Download the National Real Estate Post mobile app today. Available on Apple Store and Google Play. Just search National Real Estate Post.